had direct strikes by Iran on Israel. You had direct strikes from Israel on Iran. For a week or two in October, there was serious discussion of Israel bombing Iran's main crude export facility at Clark Island. I happened to have been on paternity leave at that time, so that made for some interesting reading for me. But I mean, this year could also be dramatic, and you could see escalation in the Middle East, or at least discussion of escalation, and that's going to be reflected in a change in the premium. So less than $5 now could be a different story in a month or two. On OPEC, on the price and OPEC, I mean, I would agree. I think Trump is bearish for oil prices, but I think the market outlook is bearish for the year, with greater upward pressure in the first half of the year than in the second, from sanctions both on Iran and Russia. By the end of the year, though, that's going to get outweighed by sluggish oil demand growth from China, sluggish oil demand growth in general, honestly. I mean, you don't see, outside of India and some additional barrels elsewhere in the global south, you don't see big drivers of increasing demand growth. And that's going to start showing in the latter half of the year. On OPEC, I mean, our call coming into 2025 was that OPEC was going to increase in April. So we were a little bit outside consensus. When OPEC announced that they were going to stick with that call, I think there was some surprise on the market. But our view has been that the group is going to stick to this decision. It's driven by internal dynamics as much as anything else. The view inside OPEC is that we want to produce more. We got to get more barrels on the market. We've got to shift from market management to a market share capture strategy. The trick will be in how to manage that slowly. There's no desire to flood the market now. Saudi will lead the charge in gradually increasing production.